The Accunet Mortgage and Realty Show is sponsored by Accunet Mortgage, an equal housing lender, NMLS ID 255368, and Accunet Realty Advisors, which is a separate company from but still affiliated with Accunet Mortgage.
Putting a roof over your head without the headache. Get answers to all of your home buying questions. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
And our Sunday best to you. Good morning and welcome to the Accunet Mortgage and Realty Show. I'm Steve Kettler, along with Accunet Mortgage and Accunet Realty Advisors owner Brian Wickert. Licensed millennial loan consultant David Wickert is with us as well here on. I'm sorry, David's got the day off today. What am I saying?
Yeah. Yes, he does. I was going to say, wow, where is he?
my brain is at Summerfest is where it's at. If you have a question or a comment, you can text or talk it in at 414-799-1620. Boy, this situation involving the condo purchase, Brian, really caught my eye because if you're not following the Fannie Mae rule book, as a condo operation, you're really setting your, condo owners up for some big headaches here.
Yeah, we've talked about this from time to time before, but we have a prime example again, and this is a rather large condo development. I think it's 244 units. And so what happens, it always comes down to two things. Does the budget meet Fannie Mae's requirements? And then the second thing, do they have the right insurance that Fannie Mae is looking for?
You know what, Brian, your connection is starting to drop out on us here, so I'm going to have you just kind of reset and reconnect with us here so we can actually, because it sounds like you're underwater at this point, and I don't think that'll be a good thing. We'll also be talking a little bit later on the program. We got a call from a home buyer this week who had used a rather large nationwide online lender to get their pre-approval. And then after they got their offer accepted, the lender that they were going to work with said, we can't give you that loan. So how did that come about? Why did that come about? And how is Accunet stepping in to save the day on that one? We'll check in on that. And also, this is an interesting story here from the National Association of Realtors. They have a new study out there that's titled Hurdles to Home Ownership, Understanding the Barriers. And we'll take a look at their 5 hurdles. And then we'll give you Accunet's perspective on whether or not those are hurdles or maybe just minor little speed bumps as we work our way through the Accunet Mortgage and Realty Hour on this Summerfest weekend here on 620 WTMJ. Let's see if we can pull Brian back into the conversation here and continue forward. And again, if you have a question, you can call it in or text it in on the Accunet Mortgage talk and text line. That number is 414-799-1620.
All right, I'm back, Steve. Do I sound like? I know we had a lot of rain.
Oh,
but am I back on the dry land?
You're back on the dry land, brother. It sounds a lot better.
I don't know what happens with that technology sometimes. Anyway, so the deal with condos is it always boils down to two things. It's either the budget doesn't meet Fannie Mae's requirements for the situation at hand, or it's insurance. And in this particular case that we had this last week, it was both that were a potential problem. Let me explain further that we get nosier as lenders the smaller the down payment, or the riskier the type of occupancy. So let's say it this way. If you're buying a condominium and you're getting conventional, you don't want a good old-fashioned 30-year fixed-rate loan, which is what, frankly, about 90% of people want, and you're putting 10% down or more, you're going to get a very light review of the facts, okay? We're not going to get that. No, we're not going to ask for the budget of the condominium. The case that we had this last week, Steve had 5% down. All right, so, now you're putting less down. That's riskier. Fannie Mae wants lenders to get more nosy about the health of the condominium project. And so in this case, the condominium association, we looked at their budget, and the Fannie Mae requirement says, hey, if you're collecting $30,000 a month in homeowners association dues, we want to see that you are setting aside $3,000 a month towards reserves, right? We want to make sure you have a cushion. And so we unfortunately got the budget late in the process with only about a week to go before closing. And sure enough, they had a line item for general reserves in the budget. But guess what the number was that was there? Do you think it was $3,000? No. It was zero. They were not setting aside any money for reserves. So, of course, we inquired like, hey, why are you guys doing that? And we got a nice email back from the president because we have $700,000 in our reserve fund, and we don't think we need to budget this year for additional reserves. We've got enough saved up. But the problem is that's not the way the Fannie Mae rule book reads. It doesn't say if the association thinks they've got enough money saved up, then skip it. It says you got to have, in this case, that $3,000 line item on there. So that was the first fatal problem. There was another fatal problem with the insurance that we were able to get around. I'll finish up the story when we come back from this first break.
Right here on the Accunet Mortgage and Realty Show on 620 WTMJ.
Home buying advice from the guys who know it best. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Yeah, Pink doing her thing tonight, 7:30 on the American Family Insurance Amphitheater stage. You're listening to the Accunet Mortgage and Realty Show. You know, as most experts agree, the Brewers' major league and minor league rosters are chock full of talent around the infield. So how will manager Craig Counsell go about balancing all of it the rest of the way? Matt Pauley takes that up during Wisconsin Sports Weekend beginning at 12:07 today, broadcasting live from Summerfest, sponsored by Wisconsin Harley-Davidson in Oconomowoc. So we've got Chris, who joins us from Waukesha with a question for you, Brian. Good morning, Chris. Go right ahead.
Good morning, guys. Thanks. I love your show. Was wondering, about the end of the year, we are going to hit that magical 20% number on our home, and wanted to know about the refinancing and how I should go about getting ready to do that for getting rid of my PMI.
Oh, I love that call, because you might already be eligible today for getting rid of the PMI because home values have been going up. So when you're thinking, hey, you're going to hit that magic number, Chris, of 20%, what are you using for home value? Or have you accounted for rising home values?
I've slightly accounted for it. I haven't had somebody come and reappraise because I've put central air in, I've redone the kitchen, things like that.
Okay, and when did you buy your house? When did you buy it?
2 years ago.
Okay. So, and you're in Waukesha, so I'm just going to say that your house is probably up, let's just say conservatively 4% in 2 years in a row. Just, general rule of thumb. So you're probably up 10% already. Now, here's the other thing. So I got two bits of advice for you. First of all, either leave your number with Rachel, our producer, because we should take a look at some what-if scenarios right now. And the reason I like right now better than the end of the year is because we know rates are good right now. And there's a chance, and we saw a little bit of this last week. Rates crept up just a little bit. Why? Because interest rates over in Europe went up this week, and we're one big global economy right now. So I always like a bird in the hand versus two in the bush. The other thing that we've done for a lot of people, and we're getting some really good pricing execution on this. Let's say you only have 15% equity. Turns out we send the appraiser out there and you only have 15% equity. Well, we have invisible mortgage insurance, meaning I can bake it into the rate. I can bake in that little cost, and especially if you have good credit. Do you think your credit's excellent, super excellent, fair?
Probably good. We had to do some work to initially get the home loan, but now I think we just finished paying everything off except for the house and the car loan.
Oh, well, that's going to boost your credit score as well. So at no cost to you, this is what we do all the time. You can click on the blue button. You can leave your number with Rachel, or just give us a call tomorrow at 262-781-1100. And let's at least do an initial analysis right now of what the options are. because I think you might be surprised at how much money you can save by getting that PMI to go away. Not necessarily, don't necessarily have to wait. All right. Thanks for calling into the show. That's a really good question. I think there are a lot of people out there in Chris's situation where they bought a house 2 years ago. Maybe they're paying expensive FHA mortgage insurance. Maybe they're paying private mortgage insurance. You don't even have to have your rate go down in order for you to benefit from a refinance that makes your mortgage insurance go away. And the key combination is he's been paying the principal down, his credit's getting better, and home prices have gone up. That's the recipe for some real money savings. So if anybody out there is listening, it's in the same situation as Chris, or knows somebody who is, right now, this coming week, don't delay because rates are still great. Click on that blue button and let us give you a no Social Security number required refi checkup. Or in the case of Chris, what I'm going to recommend we do is we're going to actually check his credit. That has so much to do with the pricing of a loan these days. We're gonna do that. That's no cost to Chris or anybody else who calls up. All right. I think it's time for another break. Yes, it is. And so when we come back from this break, we are going to get back to the story of how I would, if I owned a condominium, I would get on the board and I would do these two things relative to making sure my association was compliant with Fannie Mae guidelines when we come back.
Right here on the Accunet Mortgage and Realty Show on WTMJ.
Getting you into the home of your dreams. Here's more of the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Yeah, it's Andy Grammer. He's on the Briggs & Stratton Big Backyard stage at 10 o'clock tonight. You know, you've heard him here on WTMJ for years, but did you know our very own Jim Peck was one of the most popular TV game show hosts of his time? And his interview show on MPTV had him sitting across from some of the most iconic newsmakers in the city, state, and U.S. history. So what's the secret to his longevity and the success he's had in broadcasting? Don't miss this weekend's edition of WTMJ Conversations when Eric Bilstad takes a stroll down memory lane with our own Jim Peck. That's this morning at 11 a.m. Brian Wickert is with us as we delve back into a condo sale situation that discovered, hey, this condo association isn't following along Fannie Mae guidelines and the rule book there. So if you're a condo owner in that development, you know, it's going to be tough for you to sell out or be able to buy in.
Or refi. Or just refi,
if
you're a person who just wants to refinance, and then, oh my goodness. So what's the takeaway from all this? If you're a real estate agent and you're, taking a listing on a property, you want to look into this, because what if you get an offer from somebody who's putting less than 10% down? That's going to open up, the condo association to more scrutiny. By the way, the more in-depth condo review also occurs whenever a person is buying a condominium to use as a rental or a second home, all right? So you only get the advantage of this light touch. We aren't going to look at it very much if you're buying a primary residence with 10% down or more. That's called a limited review. So we're in the realm of full review, and the problem again was this association decided, we don't need to put aside 10% of our monthly operating budget towards reserves, which is the Fannie Mae requirement. Why? Because we have all this money saved up already. Well, there is a workaround for that, and that would be to obtain a professional reserve study. But I got to tell you, not too many condominium associations want to spend the money to hire a condominium reserve specialist to work up a report that analyzes, do you really have enough money saved up? I did a little math on the back of a napkin, and I divided $700,000 by 244 units, and that's only about $3,500 per unit that they have in reserve. So even though it sounds like a lot of money, that's $700,000. Well, what if you had to put a new roof on every place? That's going to be more than $3,500, perhaps. So long story short is, I got a hold of that budget. I'm the chief problem-solving officer. When the going gets rough, then I get called in. And I looked at that budget, and I was able to see that even though they didn't have a line item, they had transferred already $36,000 from their regular operating budget to the reserve. And it also happened to show on the single Excel spreadsheet that they did it last year, too. So we raised the argument that even though they didn't have a line item on here, They were actually doing it anyway. So could you please, make an exception this time, Mr. Fannie Mae or Miss Fannie Mae? And they did. But they said, this is the only time we're doing that. Don't ever try it again. So the bottom line is, if I was on a board, I would make sure I was doing everything right according to the Fannie Mae and Freddie Mac rule book so that it was easy for anybody to buy or sell or refinance a unit in my property. I'm going to come out with a blog post on this coming up and also put it in our Trusted Advisors newsletter because there are other details relative to insurance that can also trip up people on condominiums.
Sure.
Time for the news coming up. When we come back, I've got a real life story from this week. Took a call from a home buyer who used the nation's largest online lender to get their pre-approval and then found out 2 days after they got their accepted offer, oh, we can't really give you that loan. We'll cover that when we come back.
Don't break the bank to get into a house. Back to the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Yeah, Peter Frampton on stage tonight at 9:30 at the Uline Warehouse stage. So have you had a chance to get out to Summerfest yet, Brian?
I did. I went on Thursday, just kind of headed down there, got an invitation from somebody, and it was packed, man. I went at, left the office at about 5:20 and fought the crowds, but it was a beautiful night, and we got to see the fireworks because they were delayed from Wednesday. I haven't told Becky. You know what? Today is my 34th wedding anniversary. If Becky's listening while she's out hiking, happy anniversary, honey. It only
Congratulations.
like,
my wife and I did 31 this past week.
Well, then you're in the billion second club. If you've been married for 31 years, it's a billion seconds.
Well, I never did the math, but I'll take your word for it.
Becky said it only seems like 900 million. Gone by
Yes, that's
like
awesome.
That. Anyway,
So
maybe we'll go back
what's,
to Summerfest tonight. Yeah, let's talk about this.
What's going on here? This is just crazy. So somebody gets an online approval or a big lender approval, and they pull out?
The one whose name rhymes with Schmicken. And it was kind of funny when she called me, and I called her back. She started out by apologizing. I'm really sorry that I didn't, call you guys first, but I just thought it would be easier. And I didn't really know that you made loans in Florida because what they're doing is they're Wisconsin residents and they're relocating to Florida. Her husband is in the airline type industry, so he can work from anywhere. Unlike us, normal people that take cars to work, he takes an airplane. So it doesn't matter where they live, and they want to move down to Florida, which is great. So anyway, I said, no problem. Tell me what's going on. Well, she did a slapdash online pre-approval, then went out and got the accepted offer on the house, and then got told two things. The accepted offer, by the way, said we're going to get a 30-year fixed rate normal Fannie Mae, which is called conventional, and we're going to put 15% down. Okay, so they included their pre-approval from that big company whose name rhymes with Schmicken. And then after they got the accepted offer and got back on the phone to say, great, now let's really get going with the real approval, they got told two things. Well, you don't have that much money in your bank account. You don't have enough money for 15% down. And the person said, well, my husband's got these checks coming from, customers that he's billed, and, we'll have enough money. And then, by the way, Schmicken told him, you didn't tell us that you had a foreclosure 6 years ago. And that makes you ineligible for Fannie Mae financing. Oh. So that's when she called me. And so the rule, just to anybody listening, is that if you've had a foreclosure or deed in lieu of foreclosure or short sale, Fannie Mae makes you sit on the bench for 7 years before you can apply for a new mortgage. The answer, the way we're going to pull this off, is to give her an FHA mortgage, because there you only have to be on the bench for 2 years after a foreclosure. And then we pointed out to her that, with an FHA loan, gosh, there's no difference in the cost of the mortgage insurance, the FHA mortgage insurance, whether you put down 15% or 3.5% or 5%. Or so we proceeded to right-size her mortgage so that the money on hand actually fits, the down payment that they're going to make. And the timeout, hey, this would have never happened if she would have called Accunet Mortgage for a rock-solid guaranteed pre-approval. Why? because we would have gotten her asset information, and we wouldn't have allowed her, or wouldn't have recommended that she go write an offer, with a down payment she doesn't have verified. Because, money on the come that the husband's clients are going to be paying him. What if they don't come? What if they don't pay on time? So let's go with what is. So we would have verified that, and in every telephone application we take, we ask the person, have you had a foreclosure, deed in lieu of foreclosure, or short sale in the last 7 years? And she's an honest person. She would have said yes. And then that would have pointed us in the right direction immediately, rather than her, kind of having this little bit of a heart palpitation after she has the offer. So there is a real live example of why the rock solid guaranteed pre-approval is so important. The other thing we found out, Steve, is that the house they have now in Wisconsin, they have on a land contract. Well, that doesn't report on a credit bureau. So we have to take some extra steps now to verify. We have to get, I think it's 6 months of checking account statements to show that they're paying that on time. So, it's like now we're doing all this homework that could have been done weeks ago. But now we're going on the gun. And she's very cooperative, happy to do it. And, but still, that's why getting that rock solid pre-approval ahead of time is such a benefit. It just makes it so much more relaxing, and then there aren't these surprises that come up. One last thing that I was scratching my head on, and David is actually handling this particular application, but I said, ask the real estate agent whether they feel there's a need to disclose now that she's going for FHA financing, because the offer was written as Fannie Mae financing. And you might remember we had a story that I want to follow up with right after this break about the home buyer that we pre-approved for FHA that was having trouble getting his offer accepted. I've got a follow-up on that topic when we come back.
Right here on the Accunet Mortgage and Realty Show. If you have a question or a comment, you can call or text it in on the Accunet Mortgage Talk and Text line. That number is 414-799-1620.
Important home buying questions and answers you can count on. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Yeah, it's a Steve Miller Band. They'll be on stage tonight, 9:45 at the BMO Harris Pavilion at Summerfest. You're listening to the Accunet Mortgage and Realty Show here on 620 WTMJ. Schools that once taught classes like home ec and shop class, I remember that. Well, now there's a push to add personal finances to public school curriculum. Yeah, it's about time. Gene Miller talks to an education expert about that idea at 6:20 tomorrow morning during Wisconsin's Morning News. So Brian Wickert is with us, and we're now focusing in on the comparison between FHA and Fannie Mae and how that can kind of take a different twist or turn depending on what you're trying to do.
That's right. So we had a first-time homebuyer come our way, let's say about 2 months ago, 60 days ago. And their credit isn't bad, but it's not top-notch. It's between 680 and 700. Top-notch, when you get into the lower down payments, you actually get a break on the cost of private mortgage insurance if you are in the 760 or 780 category. And so what happens when you combine, these people want to make a very minimal down payment, 3%. They made too much money, combined household income, to qualify for our favorite first-time home buyer program, which is the 30-year fixed-rate WIDA program. But that has income limits, and these folks make too much money. So Fannie Mae, though, has a program, 3% down, as long as you're a first-time home buyer. Great. But the private mortgage insurance monthly, if we went that route, was $226. And if we went FHA, which has a lower mortgage insurance premium, monthly mortgage insurance, and also a lower rate because it's government insured, well, that payment was $140 less to go FHA. So in laying this out, the people kind of said, well, we want to go FHA. And I said, well, just so you know, when you submit an offer that says you're going to get FHA financing, sellers don't like that. And sure enough, now they've been out shopping for 3 weeks or so, and they've lost out on some offers, and specifically on one that I know of where the seller said, the seller's agent, the listing agent said, Didn't take the offer because of the FHA financing. So they came back and said, well, maybe can you rewrite us at rock solid pre-approval? But with the conventional financing, we'll take the higher rate. And the great news that happened was in the intervening time, we got access to some less expensive single premium mortgage insurance. And this is a product that we pay for as a lender. And the way that we fund it is by increasing the interest rate, so that when we go to sell that loan on Wall Street, we're getting more money for it, and we use that extra money to buy a single premium private mortgage insurance policy that then results in no monthly PMI. And as luck would have it, we can now do, with this access to the new cheaper single premium MI, we can make their payment just $10 more per month than the FHA alternative. Even though, if you looked at this side by side, and I don't know if you had a chance to open up the email that I sent you, but on the face of it, a normal human being would pick the FHA every time because it has an interest rate of 3.75 and an annual percentage rate of 4.8. So, if I just talked to 100 people and said, would you rather have that, or would you rather have a 3% down Fannie Mae loan at 5.125, but it has no monthly PMI? Well, everybody picked the FHA because of that headline rate of 3.75. But when you really grind the beans and you get down to the brass tacks, it's only a $10 monthly payment difference because the 5.125 with the 5.176 APR has no monthly mortgage insurance whatsoever. So these folks are delighted, and now they're out there shopping with a conventional, meaning a non-FHA, 3% down rock solid pre-approval, and I think that's going to be the key to helping them get an accepted offer. That's kind of the cool thing about dealing with an independent mortgage banking company like Accunet is we really try to have all the tools in the drawer. FHA, WIDA, Fannie Mae with 3% down, monthly PMI, single premium PMI. We really try to have the Swiss Army knife of mortgage tools so we can do the best job for each and every customer that comes our way. All right, when we come back, I want to talk about a study that the National Association of Realtors had commissioned that claims that our home ownership rate is too low, and one of the culprits is that mortgage credit requirements are too tight. I say bologna sausage, and I'll tell you why when we come back.
Right here on the Accunet Mortgage and Realty Show on WTMJ.
Find a place to call home without the headache. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
The Sounds of Pink, and she'll be doing her thing tonight, 7:30 on the American Family Insurance Amphitheater stage at Summerfest. I'm Steve Kettlear, and that right there, that's Brian Wickert. David Wickert has the weekend off here on the Accunet Mortgage and Realty Hour on 620 WTMJ. So the National Association of Realtors comes out with this study entitled Hurdles to Home Ownership, Understanding the Barriers. But are they really barriers?
Well, I think that depends who you ask, and it sounds like you're asking me, Steve, so I'm going to chime in with my opinion. There are 5 that the association identified, and they hired some smart people to do this kind of research and thinking and gather some facts about it. And here are the 5. Number 1, post-foreclosure stress disorder. They say there are long-lasting psychological impacts on financial and housing decision-making resulting from millions of people who experience foreclosure or loss of jobs, as well as those who watch these hardships play out on a family or friend. They're talking about millennials who saw their parents suffer. It suggests that home ownership financial literacy, which you were just talking about with Gene Miller, going to have that on tomorrow, and mortgage debt workshops and programs may be helpful. All right, so I believe in that. I think that's legit. This is the one I take umbrage with. Mortgage availability. Credit standards have not normalized following the recession, and prospects with good to excellent credit scores are not getting approved as they once did. Underwriting lending requirements may need to be readjusted to accessible standards. That's where I call bologna sausage. And let me give you some examples. We closed on a loan in May. The borrowers have 624 credit scores. That's low. It's an FHA loan. They put 3.5% down. Barely had enough for that. And debt-to-income ratio, back in the old days before we had computers, Fannie Mae said you shouldn't spend more than 36% of your gross monthly income on all your monthly debts. Then when I was a young man in the mortgage industry, that crept up to 38%. Now the government's official standard is 43% is the maximum you should spend of your gross monthly income. That's before taxes are taken out or health insurance or anything like that. Oh, but don't worry. Fannie Mae and Freddie Mac will routinely go to 45%. Oh, wait, Fannie Mae just announced that they're going to now allow debt-to-income ratios up to 50%. And for this aforementioned home purchase on the FHA loan, that one went through with a 54% debt-to-income ratio. Does that sound too tight to you, Steve?
No.
No. And we can do 3% down, right, on a Fannie Mae loan. We can do 0% down on a WIDA, combined first and second mortgage. APR is probably around 4.375 with no monthly PMI. VA loan 0% down. So sitting at the front lines of mortgage lending and real estate, that doesn't seem too tight to me. When it's gotten more liberal, my jaw almost hit the desk when I saw that Fannie Mae was liberalizing their debt-to-income ratios from a max of 45 up to 50. So that's my comment. I don't think that lending standards are too liberal. They are getting more liberal, which is like, really? Didn't we know how this story ended before? And that's what all real estate agents would love, I suppose, is more liberal standards so everybody can buy a house. But that's what we did in 2006. That's how we got the homeownership rate up to 69% or something like that. It's now around 63.6, but maybe those people on the margin shouldn't own homes because they're at a much higher risk to lose them. I was talking to our rep at Wells Fargo where we place a lot of our 30-year fixed-rate mortgages. He said the delinquency rate on loans that they service where the debt-to-income ratio is between 45 and 50 is astronomically higher. People just can't, any little bump in the road, and they can't make their mortgage payment. The other ones that are listed as burdens to home ownership, growing student loan debt burden. I agree with that, but going back to Gene Miller's upcoming interview, people who get student loans don't have to prove that they have any hope of paying them back. And you literally see teachers with $95,000 of school loan debt. It's like, really? Didn't somebody sit you down and say maybe you shouldn't go to that really expensive school? And pay attention to what you're going to rack up in student loan debt. The other ones are that by the way, though, we just loosened the underwriting standards in mortgage world for student loan debt. So that's getting a little more liberal there. The other two are single-family housing affordability, that's supply and demand, and the supply relative to not enough homes being built. I agree with those two. So, the real problem right now for first-time homebuyers is a lack of inventory. And that's why you got to do two things. If you're out there, I don't care if you're shopping for your next home or your first home, you got to be working with a good buyer's agent. I can help you with that at Accunet Realty Advisors. And you got to have a rock-solid, guaranteed pre-approval to buy. Don't kid around. You want to be out there as the most serious and best version of yourself when you're shopping for a house. You can find out about those two things at Accunet.com or give us a call at 262-781-1100. We'll see you back here next week, Steve. Thanks a lot. The preceding was a paid program. Advice and opinions expressed during the Accunet Mortgage and Realty Show are solely that of the hosts or guests of Accunet Mortgage and Accunet Realty Advisors and not WTMJ Radio or Scripps Media Incorporated.